Picture this. It's April 7th, 5:32 in the evening. Donald Trump hops onto Truth Social and drops a bombshell, a ceasefire with Iran. And honestly, that one post taught us two things. Number one, Truth Social is apparently the most important piece of technology mankind has ever built. Definitely not a random social app nobody asked for. And number two, and this one actually matters, Wall Street hates not knowing what happens next, because the very next morning, the market went absolutely nuts. The S&P jumped 2.5%, the Nasdaq nearly 3%, and the Dow up more than 1,300 points, its best single day in almost a year. And it didn't stop there. A few weeks later, stocks hit brand new record highs, even while, get this, the ceasefire was literally falling apart on live TV. Now, the talking heads on financial news had a neat little explanation. It's a relief rally, they said. The market's celebrating peace. Yeah, no, that's not what happened, not even close. And to get why stocks can be partying at all-time highs during an actual war, you've got to rewind, because what was happening under the surface, way more interesting than some feel-good peace story. Let's go back a bit. February 28th, the U.S. and Israel hit Iran with joint airstrikes. Iran's supreme leader gets killed. Then Iran slams the Strait of Hormuz shut. And the market? It went into a nosedive, its worst 5-week losing streak in almost 4 years. By the end of March, the S&P was down nearly 9%. Quietly having a panic attack, something else was brewing behind the curtain. Wall Street was freaking out. And I don't mean a little nervous. Hedge funds were dumping stocks at the fastest pace in 13 years. That's not me guessing. That's straight from the data. See, Goldman Sachs runs this thing called a prime brokerage desk. Basically, they service most of the big hedge funds, which means they get a front row seat to what these guys are buying, selling, and how much borrowed money they're playing with. And Goldman's numbers? Brutal. Q1 selling in North America was the biggest since April 2020. Leverage was sky high. And bets against the market, shorting funds like SPY and QQQ, hit levels we hadn't seen since the pandemic. Everyone was scared. And one analyst put it in the darkest terms possible. Around mid-March, a commodities guy named Rory Johnston basically said, "Imagine a giant explosion in the Middle East oil supply chain. A shockwave so big the whole system starts to crack." He said if the strait stayed closed, the world would have to cut 15 million barrels of oil a day. Prices? $250, maybe $300 a barrel. All-time highs, guaranteed. And a recession? Nah. He called it depressionary. Every analyst he talked to, even the ones who normally laugh at doom and gloom types, were terrified. Hold that thought, because 6 weeks later, that take becomes the funniest thing you'll hear all year. We'll get there. But the point is, everybody was bearish. Everybody. Then April 7th happens. Trump posts. And the next morning, the market opens like somebody flipped the money printer back on. Over 400 stocks in the S&P finished green. 13 of them hit all-time highs. Oil crashed. Brent down about 13.5%. WTI down over 16%. Biggest one-day oil drop since 2020. But here's where the peace rally story starts to fall apart. There's a firm called Windward. They use AI to track ships, cross-checking GPS signals with satellite images. And by midday, they'd only spotted 5 ships moving through the strait. 5. Normally, around 130 a day. That's a 96% drop. The strait wasn't open. There was no peace breaking out. So the relief rally explanation? It doesn't add up. Which leaves us with the real question. If it wasn't peace, what actually sent stocks flying? And the answer is a beautiful old-school short squeeze. And I can prove it. But first, quick crash course. When you short a stock, here's the deal. You borrow shares from someone, then sell them right away. You're betting the price drops so you can buy them back cheaper later, hand them back, and pocket the difference. Simple enough, if the price falls. But what if it goes up instead? Now you're in trouble, because you still have to return those shares, and now they cost more than you sold them for. And if the price keeps climbing, your losses just keep growing. Eventually, your broker taps you on the shoulder with a margin call. Translation, put in more money right now or close the trade immediately. Now imagine thousands of people getting that call at the exact same time. They all rush to buy back their shares. That buying pushes prices up, which triggers more margin calls, which triggers more buying. That, my friends, is a short squeeze. And on April 8th, with bets against the market at their highest since 2020, the squeeze went off like a firecracker. But that was just domino number one, because once stocks started ripping, the robots woke up. Enter the CTAs, Commodity Trading Advisors. These are trading firms run entirely by algorithms. They don't read the news. They don't care about wars or presidents or peace deals. They follow one thing, the trend. Trend's going down? Sell. Trend flips up? Buy. Cold, mechanical, emotionless. And Goldman said these CTAs were sitting on a $30 billion bet against the market going into the ceasefire. But the second stocks crossed certain trigger points, their models flipped. Not to neutral, straight to buy. Goldman first guessed they'd need to buy back around $40 billion in stocks. The real number? $86 billion in just 5 days. One of the fastest buying sprees Goldman has ever recorded. And then, domino number 3, the options market. Okay, stay with me. When people buy a ton of call options, the dealers on the other side have to protect themselves, so they go out and buy the actual stock to stay balanced. Now, a data firm called Spot Gamma had flagged something scary heading into all this, a negative gamma setup. In plain English, that's when dealer buying stops calming the market and starts fueling it. Price goes up, dealers buy more. Price goes up even more. It feeds on itself. So put it all together, a short squeeze, plus the algorithms flipping, plus dealers forced to buy. 3 dominoes, bang, 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 one after another. That's your rally, not peace, mechanics. And here's the funny part. We've seen this movie before, over and over. Go back to December 2018. Stocks had been sliding for months. Everyone terrified of rate hikes. Then Jerome Powell walks on stage and says one word, patient. And boom, the Dow explodes for its biggest single-day point gain ever. Or August 2024, the Bank of Japan raises rates for the first time in 17 years. The famous yen carry trade starts unraveling. Japan's market drops 12% in a day, then bounces 10% the next. Different triggers, same exact machinery. And here's why it keeps happening. The stock market itself has completely changed. 20 years ago, real humans ran the show. Portfolio managers reading earnings reports, analysts crunching numbers, people actually deciding what a company was worth. That world is basically gone. Today, 63% of all U.S. stock funds are passive, index funds. That's over $13 trillion of what I call blind money. It doesn't read a single earnings report, doesn't care if Apple had a great quarter. It just buys the index, on autopilot. And since most of these funds buy based on size, the bigger a company gets, the more they buy, which is exactly how the Magnificent Seven now make up over a third of the entire S&P 500. So a huge chunk of the market isn't being priced anymore. It's just getting money by default. And the human side that's left also changed. Hedge funds have merged into a few giant players, the Citadels, the Millenniums, the big multi-strategy monsters. They run at 4 to 8 times leverage with strict rules. So when they hit a loss limit, they don't sit around debating the Fed or the war. They just sell instantly. And underneath all of it, the options market. Same-day options now make up around 63% of all S&P trading. On busy days, over $2 trillion changes hands in a single session, and every one of those trades forces a dealer to hedge in real time. So the big players in 2026, they're not studying value or fundamentals, they're just reacting. And when one reacts, the next one reacts to that. And it all stacks up. That's April 8th in a nutshell. And once you see it, once you get the machinery behind why the market acts so crazy, everything kinda clicks into place. So look, if you're sick of the news handing you the baby version of what's really going on, hit that subscribe button, because this is the stuff they always seem to leave out. The old market, the one where you found a good company and invested for the long haul, that market's gone. What's left is a giant feedback loop. Algorithms, passive funds, and options dealers, all just reacting to each other on repeat. And the headlines? They're just the story we tell ourselves to make it all make sense.